now that Powell has indicated that we're going to start cutting rates, there's no chance that that 3% is going to become 2%. It's going to go to 4, 5, 6. It's going to keep going up. The real reason that Jerome Powell is thrown in the towel on the inflation fight, although he wants to pretend he won the fight, right, is because of the economy. And he even mentioned that during his speech today. He said that any additional weakness in the labor market is unwelcome. See, before he was saying we wanted some weakness in the labor market because that's how we were going to bring down inflation. But now, based on all of the weak data that we got on the labor market, especially that last non-farm payroll report, he's saying no mas. We can't have any more weakness in the labor market. So the Fed has really pivoted now from fighting inflation to fighting unemployment, which is on the rise. And the Fed, claims it has this dual mandate. One is for price stability, which it's redefined as rising prices, and the other is a low unemployment. And it now realizes that part of its mandate is in jeopardy. And of course, the idea, and I've debunked that on the podcast, that we have low unemployment is a farce. We don't have low unemployment. We're just not counting all the people that are unemployed as being unemployed. If you want to see what the real unemployment rate is, and that's not even all of it, look at the U6 numbers. I talked about this in the last podcast. They are historically high already, and they're going to get a lot higher. In fact, another data point that came out during the week was the downward revision by the Bureau of Labor Statistics. These are the guys that give us these non-farm payroll reports every week. And now they came out exactly like I said they would do. I've been saying this for months and months and months on my podcast. They came out and they revised down the whole year, all the job reports for the past year, or I think year to date, or past year. And they said, you know what? We actually created 818,000 fewer jobs than what we reported. That's 68,000 jobs a month. That is a big number. Basically, they went from an average of 242,000 jobs a month to 174,000. And it probably means that most of the months where the markets were celebrating a beat, it was actually a miss. And that's why I kept saying on this podcast, these numbers mean nothing because they're going to revise them down. And of course, even without the revisions, they were all a bunch of BS. I knew that. When you look at the household survey, you can see all the real jobs being lost, full-time jobs being destroyed, replaced by part-time jobs for people who are forced to moonlight because that's the only way to pay the rent or to put food on the table. And so it's all part-time jobs that are going to immigrants. So I knew this was all a bunch of BS. Plus, so many of the jobs are government jobs. Where are those jobs coming from? Well, we're running bigger deficits to create these jobs that do nothing to add any productivity to the economy. So we're just paying people to consume because they're not producing anything when they're getting a check from the government. When they're productive is when they get a check in the private sector for actually helping to make something or provide a service that people want. People don't want what the government is providing. They're just basically providing a bunch of red tape. They're making it harder for the rest of us to be productive. But I knew we were going to get this downward revision. Now, I was thinking they would hold off until after the election. So I was kind of surprised that they, showed their cards so soon before the election. Maybe they felt that they could do it because, Kamala had shot up in the polls. And so, when Biden was there, it was like he had no shot. So maybe they wouldn't have done it, but maybe they thought, okay, we can do some of the revisions. But I don't even think it's enough. I think that there's going to be another revision after the election because I think it should be bigger than 818,000. I think there's more jobs, but even the 818,000, I think this is the second biggest revision ever. And of course, it's not a coincidence that they over-reported the jobs, right? They don't go back and say, hey, we actually created a lot more jobs than we told you. No, the revisions are all down. And that's because the government was biased in trying to come up with a big number. And so that's why you had all these numbers that were overestimating what actually happened. And so now they're going back and they're correcting it. And I think more corrections are coming. But Powell got this information during the week. And now he realizes, oh, my God, we don't have all the jobs that we thought. The unemployment rate just spiked up. Even the U3 number that we use is at 4.2 and rising because it was down a lot lower. And so now the Fed is worried about the economy, about employment. They're not coming right out and saying they're really worried. They're still pretending that we have a good economy. Well, if the economy really was good, they wouldn't be cutting rates because there's no indication that inflation is going to go down. In fact, there's every indication that inflation is going to go up. If you want to look at the market data points, look at the price of gold. Mentioned that on last Friday's podcast, where gold closed above 2,500 for the first time ever. It closed a week above 2,500, and it closed this week above 2,500. Despite a big sell-off yesterday, we recovered those losses today, and we closed at a new record weekly close at 25.13. That was about a $5 move up from the record weekly close last week. Intra-week, we set a new record high for gold. We got above 2,530. I forget exactly what the peak was, maybe 32-ish, around there. But gold prices keep going up. Gold stocks didn't have that big a week. Many of the big name stocks did hit new 52-week highs today, and the GDX managed to hit a 52-week high, but the GDXJ, the juniors, did not. And we're only up about 1% on the week. So not a big move up, but no move down, right? The market didn't fall. And gold basically moved last week in anticipation of this week because we could have a big move up on Sunday night, Monday. And that didn't happen. But you know what? It may happen this Sunday night or Monday. So you have another opportunity because one of these Sunday nights, it's going to take off. That's when I think the big move is probably going to start in Asia while Americans are asleep. And based on what Powell said and how dovish he was on Friday, we'll see how this goes over. Because it's not just gold. Look at the dollar. The dollar got clobbered again this week. The dollar index closed at 100.68. This is the lowest it's been in 13 months. And if it falls a little bit more, it's going to be the lowest it's been in several years. But then there's no real support. I think the bottom could drop out of the US dollar. I think we have a chance before the end of this year to get the dollar index below 90, and that will challenge the low from 2020. And if we take that out, then Katie bar the door, because we're just going to go through a trapdoor. And in fact, where the dollar looks the weakest is against the Swiss franc. The dollar is about 7.5% from hitting a new all-time record low against the Swiss franc. Take a look at this chart. In fact, the chart for the dollar index closing at the low of the day, this looks horrible. And the Swiss franc right now, you need $1.18 to buy a Swiss franc. So the Swiss franc has gone up fivefold against the US dollar since 1971. Now, of course, the Swiss franc has also lost purchasing power over that time. There's been inflation in Switzerland. So the Swiss franc doesn't buy today what it bought in 1971, but a lot more than the dollar does, because you have an 80% decline in the value of the dollar versus the Swiss franc. So the Swiss franc has been a much better currency to have held over those decades than the dollar. And it's kind of like a canary in the currency coal mine, in that when there's a problem with the dollar relative to other currencies, you might see it first in the Swiss franc. It's a smaller currency, maybe not as much liquidity as the euro or the yen. And you're seeing some real pronounced weakness in the dollar against the Swiss franc. But what no one is really paying attention to is the inflationary implications of what's going on. See, the Fed is about to cut rates with gold at an all-time record high and the dollar breaking down. Why would you do that? Also, prices in general are at record highs. There is no indication that, we've whipped inflation. All the indications are that inflation has whipped us, and it's about to whip us even more.